If you ever sat through a business class, you heard the same line on repeat. The customer is king. If someone shows up with cash and wants to buy, you take the sale. That's the entire point. So explain this. On Monday, January 19th, 2026, one of the biggest precious metals dealers in the United States basically told small buyers, not today. Effective immediately. Online orders under $500? Not happening. A hard floor. A locked gate. And here's why that matters more than most people realize. A $500 minimum isn't a policy update. It's rationing with a corporate smile. It's the moment a retailer admits the system can't keep up. Before we go any deeper, I need 10 seconds of your help. We're running a campaign to wipe out copycat channels that steal research and repost it like it's theirs. So if you value original work, hit subscribe and comment OG John AG right now. All right, back to the part that should make you sit up straight. Because when a company that lives on volume decides to reject half the crowd, you have to ask the obvious question. Why would any business turn away paying customers? They'll tell you it's to restore service levels. Translation, they're overwhelmed. Their fulfillment pipeline is buckling. The weekend traffic didn't just spike, it slammed into the system like a wave. And yes, you heard that right. Small orders make up a massive chunk of their volume. That's not a side detail, that's the whole story. If you cut off the small stackers, you're not optimizing, you're slowing the outflow. Which means someone inside that building is looking at their vaults, looking at their shipping capacity, looking at their inbound supply, and realizing they can't keep doing business like normal. Now think about what that says about the real silver market, not the paper chart on your screen, but the physical flow of metal in the real world. If supply was unlimited, they'd do the simple thing. Hire more staff, add weekend shifts, expand the packing line, run overtime, take every order, because every order is profit. But they didn't do that. They chose the move that protects inventory, not revenue. And that tells you the priority has changed from growth to survival. This is the quiet split of the retail metals market. If you have capital, you can still get product, maybe with delays, maybe with higher premiums, but you can still get it. If you don't have capital, you're being pushed to the edge of the boat. And when you start pushing people out of the boat, you're admitting something. You don't know how rough the water is about to get. Now, they also said something that should not be ignored. Silver demand has been exploding faster than gold demand over the last 6 weeks. That's critical, because gold is what institutions hoard. Silver is what the public grabs when they're scared, when they're angry, when they're starting to distrust the system. And the most unsettling piece isn't demand. It's what demand implies about supply. Because if you can't meet demand, you don't have a marketing problem. You have a supply chain problem. You have a logistics problem. You have a capacity problem. And when those problems show up in precious metals, they don't politely fade away. They escalate. Fast. So let me ask you this. If a $500 minimum exists today, what happens next? $1,000? $2,500? $5,000? And if it can happen at one major dealer, how long until it becomes normal everywhere? Also, quick note, check the description after this video. I've dropped bonus links for you there, including the premium WhatsApp channel link and the membership link. If you want the fastest updates and the extra resources, it's all right there. Now watch how the behavior shifts when fear takes over. In a normal market, high prices cool demand. People see something get expensive and they back off. That's how a healthy price system works. But when a market enters panic mode, the opposite happens. People buy because they're scared they won't be able to buy later. They aren't buying silver because it's expensive. They're buying because access is disappearing. That's the psychology of shortages. And the retail minimum order is your receipt. This is where it gets even stranger. The dealer is telling you demand is rising even while prices are near record levels. That's classic scarcity buying. The buyer isn't thinking, is this a good deal? The buyer is thinking, will this even exist next week? Now imagine the stress on the fulfillment machine when that mindset spreads. Servers get hammered, phone lines jam, shipping departments fall behind, payment processing gets clogged, and meanwhile, the physical metal in the vault doesn't teleport. It has to be picked, packed, insured, labeled, and moved, one order at a time. And when that pipeline hits max capacity, the system gets fragile. One more spike, one more shock headline, one more viral rumor, and the whole thing can seize up. Which brings us to the numbers that were quietly revealed. Because CEOs don't usually share internal performance stats unless they're trying to explain a catastrophe. They keep data private. But this time, the message contains specifics, like someone saying, look, this is not normal. We're in emergency mode. One weekend day was described as one of their busiest in history, with volume reportedly running around 4 times a normal Saturday. Let that sink in. A Saturday is typically slower for this industry. The big market flows happen when financial markets are open. Saturdays are normally quiet. So a 4-time Saturday is not growth. It's not brand momentum. It's a run, a digital age run. Not a line outside a bank, but thousands of people refreshing a checkout page at the same time because they don't trust Monday will be safe. And if that kind of buying hit before the price even fully ripped higher, it tells you something else. People weren't waiting for a pullback. They were paying up. They were paying premiums. They were taking whatever was available. And this is where the date matters, because that weekend, January 17th and 18th, didn't become wild by accident. Weekends only turn into buying frenzies when people feel like they are running out of time. Something pushed the crowd to act while the traditional markets were asleep. Maybe it was the wave of headlines about official coin programs slowing down. Maybe it was rumors about new restrictions and trade barriers. Maybe it was nothing more than a quiet realization spreading person to person. If everyone rushes on Monday, I'm already late. Whatever the spark was, the outcome is what matters. A 4x Saturday tells you the crowd moved from curiosity to urgency. And urgency does one thing in a physical market. It converts interest into orders. People who plan to buy next month bought now. People who plan to buy 1 ounce bought 10. People who normally compare premiums stopped comparing premiums. They clicked checkout because they believed supply would vanish faster than their hesitation. Now combine that with another detail that was mentioned. The week itself was one of the busiest weeks in company history. Not just a strong week, one of the busiest ever. So ask yourself, which other weeks in modern memory even compete with that? Moments when the system scared people, financial shocks, lockdown-era chaos, major banking stress, the famous retail squeezes that went viral online. Those were the kinds of weeks that previously produced record demand. And now we're seeing another one. That's not normal demand. That's historic demand. And historic demand breaks normal rules. It breaks shipping schedules. It breaks inventory planning. It breaks the neat idea that supply chains can scale instantly. Because supply chains don't scale instantly. They scale slowly. And the physical metals market scales the slowest of all, because metal is heavy, insured, audited, and controlled. You don't just spin up new silver overnight. Now, one of the most important phrases in that message was that silver's share of total demand and revenue hit an extreme. That implies something even more powerful than raw volume. It implies buyer preference has shifted. And preference is what changes markets. When the public wants gold, you can usually find it, because the gold market is deep, liquid, and institutionally supported. When the public wants silver, the market is smaller, tighter, and more vulnerable to crowd pressure. So even if the amount of money flowing into silver is smaller than what institutions move into gold, the impact on availability can be larger, because the pipe is smaller. Think of it like forcing a river through a narrow channel. You don't need a tsunami to flood a narrow channel. A strong tide is enough. Now let's talk about the psychological trick silver plays on buyers, because it explains why this demand is so aggressive. Gold feels expensive, even when it's cheap by historical standards, because the unit price is large. Silver feels accessible, even when it's objectively expensive, because you get more units. People look at a gold coin and feel like they're making a huge decision. People look at a tube of silver and feel like they're collecting something. That unit bias is real, and in a panic, it becomes explosive. Because in a panic, people don't want one thing. They want a stack. They want weight. They want the feeling that they've converted paper into something solid. And silver delivers that feeling. That's why crowd money targets silver first. And that's why rationing shows up in silver first. Now here's the big disconnect that makes the entire situation dangerous. The paper price and the physical reality are no longer speaking the same language. The paper price responds to macro signals, interest rates, currency moves, algorithmic flows, headlines that spike and fade. Physical demand responds to trust, and trust doesn't move like an algorithm. Trust snaps, trust breaks. Trust doesn't care about chart patterns. When trust breaks, people hoard metal even at bad prices, because the price they're reacting to isn't the price of silver, it's the price of staying exposed, and that price feels unbearable. So what happens when physical demand becomes a trust-driven rush? Dealers get squeezed from both sides. Customers want product now, wholesalers and refiners raise replacement costs, and in the middle sits the dealer, trying not to get trapped. That's why minimum orders appear. That's why pre-sale programs get cut. That's why ships in 30 days turns into, we'll email you updates. Because nobody wants to make promises they can't fulfill. And when the biggest players stop making promises, the whole ecosystem tightens. Now let's make this personal for a second. If you're a small buyer, a $500 minimum forces a choice. Do you save up and wait? Or do you try to find other paths, local shops, peer-to-peer, secondary market? And every alternative comes with more friction. Local shops can be out of stock. Peer-to-peer can be risky if you don't know what you're doing. Secondary market premiums can be higher and quality can vary. So what the minimum order really does is it increases friction for the average person. And friction is a hidden form of inflation. because you're paying more, not always in dollars, but in time, stress, and reduced choice. Now, watch what happens next. When small buyers get blocked, many don't disappear. They consolidate. They pool funds with family, they split larger orders, they form groups, they buy together. And that behavior can actually increase the pressure on the dealer because instead of 1,000 tiny orders, you get fewer but larger orders that still drain inventory. So the minimum order doesn't necessarily fix demand. It changes demand's shape. And if demand's shape becomes more whale-like, the dealer might actually tighten further because the outflow becomes chunkier and faster. That is why I'm telling you to treat this as a signal, not a one-off policy. This is how rationing creeps. First, it's temporary. Then it's until further notice. Then it's industry standard. And by the time people accept it as normal, the metal is already gone. Now, there's another hidden consequence most people miss. Minimum orders change the dealer's risk profile. Small orders tend to be diversified across many customers. Large orders concentrate risk. One big buyer canceling a large order can disrupt cash flow. One big buyer placing repeated bulk orders can dominate allocation. So to manage concentration risk, dealers often implement even more rules. Payment verification, shipping delays, stricter return policies. In other words, the customer experience degrades. And that degradation is itself a sign of stress. Healthy markets compete for customers. Stressed markets manage customers. And we are watching the shift from competition to management in real time. So here's the cliffhanger hiding in plain sight. If this is happening while the dealer is still operating, still shipping, still communicating, what happens if another shock hits? What happens if a major supplier pauses shipments? What happens if delivery delays stack up to the point that chargebacks and cancellations rise? What happens if the dealer has to choose between protecting liquidity and protecting customer promises? Those are not hypothetical questions. Those are the questions that show up right before markets snap. And when physical markets snap, the paper market often lags until it suddenly doesn't. So keep watching the policies, because policies usually change before prices do. And that behavior is poison to a just-in-time inventory model. Now, here's the second layer. At the same time that buy demand is surging, sell-back supply is drying up. Even at high prices, people aren't rushing to sell their silver back. They're holding it. So you have more buyers and fewer sellers. That's the exact setup that forces rationing. It's basic arithmetic. If inflow falls and outflow rises, the vault empties. And then, to protect the vault, the gate comes down. Now we need to talk about what a $500 minimum really does. It doesn't just slow orders. It changes who gets access. It favors whales, the bigger accounts, the bulk buyers, the people who can write larger checks without blinking. And it punishes the person doing 1 ounce at a time. The mom trying to protect a little savings, the worker stacking a few rounds per paycheck, the student buying fractionals because that's all they can afford. Those people are now blocked. That's not business. That's triage. And triage only happens when the situation is bad. Now, at this point, some people will say, relax, it's just one company. No, this is the biggest reason you can't relax. The largest operators have the deepest relationships, the best access, the strongest supply chains, and the most robust systems. If they have to ration, imagine what's happening to the smaller dealers. Imagine the local coin shop. Imagine the smaller online storefront with fewer wholesalers and less negotiating power. They don't have the same cushion. So if the biggest player is putting up a wall, the smaller players are likely already out of breath. Which leads to the uncomfortable question. Are we watching the physical market quietly disconnect from the paper price? Because the chart can say one thing, but the ability to actually buy is a different metric entirely. If you can't transact, the price is theoretical. It's like seeing a sign that says, gas $2.99, while the pump is taped shut. Now I want to shift to the supply side, because this is where the story stops being scary and starts being structural. At one point, the message referenced output being hit, hard. Not delayed, not slightly reduced, hit, by something like 50%. Read that again, half. A production or throughput impact of roughly 50% is not a minor inconvenience. It's a fracture. And it raises a blunt question. What kind of business cuts output when demand is exploding? A rational factory adds shifts. It runs machines harder. It pays overtime. You don't cut output unless you can't produce. And you can't produce when you don't have raw input. So what's the raw input for private minting and dealer-branded product? Silver grain, silver shot, industrial feedstock, the stuff you melt to make rounds and bars. If feedstock is tight, everything downstream jams. And here's the uncomfortable part. Feedstock tightness doesn't always mean the world ran out. Sometimes it means the metal is being redirected. Industrial users can lock in supply through contracts. Large institutions can absorb wholesale lots that would have gone to retail, and international markets can create a bidding war that quietly drains one region to feed another. Metal follows the highest reliable bidder. If a refiner can sell big lots to an industrial buyer with fewer headaches, fewer returns, and fewer shipping complexities, that's attractive. Retail is messy. Retail is thousands of packages, thousands of addresses, thousands of tiny problems. Wholesale is one truck, one contract, one payout. So when supply gets tight, retail is often the first to feel it, even if total silver exists somewhere in the system. And if you've been watching global pricing signals, you've probably noticed something odd. At times, different regions can pay meaningfully different effective prices for the same metal once you include premiums, taxes, shipping, and availability. That spread creates an arbitrage pull. It creates a magnet effect that tugs supply across borders. Dealers don't talk about it in plain terms because it sounds like a conspiracy, but it's actually just economics. Where the margin is, the metal goes. Now add politics and trade policy into the mix. When governments start floating new tariffs, new import rules, or new sourcing requirements, it can disrupt the flow of raw material. Even if the policy is aimed at something else, it can hit metals indirectly. Suddenly shipments reroute, paperwork slows, inventory gets stuck at ports, and the dealer's supply forecast gets blurry. That is one of the reasons pre-selling 30 days out becomes dangerous, because a dealer can't promise what it can't see. And right now, the physical pipeline is cloudy. Not because nobody is working, but because too many variables are moving at once. So if you've been waiting for a clear signal, understand this. The signal is the fog. Fog in supply chains is what precedes rationing, and rationing is what precedes price dislocation. Now, if you want to understand how close we might be to dislocation, watch one thing: how quickly in stock turns into pre-order, and how quickly pre-order turns into notify me. Those are the three stages. In stock means the shelf exists. Pre-order means the shelf is mostly empty, but they're hoping. Notify me means the shelf is gone, and they don't want to make promises. If the biggest dealer is already changing rules, we are not in stage 1 anymore. We're moving through stage 2. And stage 3 is what turns calm buyers into aggressive buyers. Because nobody wants to be the person who waited until notify me showed up. No feedstock, no blanks. No blanks, no stamping. No stamping, no inventory. And if inventory isn't replenishing while demand is surging, the minimum order isn't the end. It's step 1. Now here's the part people ignore. The physical market is global. If there's a higher bid somewhere else, metal moves. Refiners and wholesalers follow margins. They don't follow your feelings. They don't follow fairness. They follow the best payout. So if another region is pulling hard on supply, industrial demand, manufacturing demand, long-term contracts, that pull can starve retail channels. And when the retail channel gets starved, the dealer starts acting defensive. Minimum orders, refusal to pre-sell, no guarantees, longer lead times, out-of-stock banners everywhere. You've seen it before in other markets. Now it's landing on silver. Another major signal here is the refusal to sell too far out. Pre-selling inventory 30-plus days out is standard practice in many retail and wholesale models. It helps manage cash flow and hedge risk. But when a dealer stops pre-selling, they're essentially admitting they can't confidently replace what they sell. And if you can't replace inventory, you don't want to promise delivery. Because if replacement cost jumps between now and delivery, you get crushed. So the dealer shifts to what's on the shelf only. And when shelves are thin, buyers panic harder. It becomes self-reinforcing. That's why these changes matter more than any one-day candle on a chart. This is the mechanics of a squeeze in the physical world. Not memes, not hashtags, logistics. Now, here's where a lot of viewers get stuck. Okay, but what should I do? I'm not giving you financial advice, but I will tell you what the signals are saying. The signals are saying the easy access window is closing. They're saying the friction is rising. They're saying small buyers are being priced out, not just by price, but by policy. And when policy starts rationing, it tends to tighten, not loosen. So yes, that means planning matters now. It means you can't rely on, I'll just grab a coin later, because later is the exact word shortages punish. Now let me pull you into a quick side lane for 2 seconds. If you enjoy silver-related success stories, real people, real wins, real lessons, there's a separate channel linked in the description. Check it out and subscribe over there too. You'll see how people used smart moves to change their outcomes. All right, back to the pressure cooker. Because the end game of a broken primary market is always the same. Demand shifts to the secondary market. And in silver, the secondary market has a name that sounds disrespectful, but isn't. Constitutional silver, often called junk silver. Old dimes, quarters, half dollars, coins with real silver content from the era when money was still money. It's not junk, it's fractional metal. And in a world where new product supply is strained, fractional metal becomes premium. Why? Because it doesn't need to be minted. It already exists. It's already in circulation, just not in circulation like it used to be. It's sitting in bags, vaults, drawers, estates, and collections. And when new bars and rounds get hard to source, the market starts hunting the existing stock. That's when premiums detach. That's when a spot price becomes less relevant. Because the secondary market is negotiated, not posted. And negotiated prices respond to scarcity faster than the paper market does. Now connect that to human psychology. If you believe a currency is weakening, you hoard the good money and spend the bad. That's a real phenomenon. People don't need to know the name of the law to live it. They instinctively do it. They keep the silver. They use the paper. And the more people do that, the harder it is to buy silver, which forces the next buyer to pay more, and the next buyer, and the next buyer. That's how shortages go vertical. So when someone tells you high prices will stop the demand, you need to look at what's happening right now. Demand is rising with price. That means the market isn't behaving like an investment market. It's behaving like an escape market. People are trying to exit currency exposure. And when people try to exit all at once, gates appear. Minimum orders, allocations, rationing. That's what you're watching. Now I want to talk about retention, because if you've made it this far, you're already ahead of most people. You're actually tracking the mechanics, not just the headlines. So here are 2 questions I want you to answer in the comments, because your answer tells me how the crowd is thinking. First, if a dealer sets a $500 minimum today, what do you think the minimum becomes if prices keep climbing? Does it double, or does it jump by a factor of 10? Second, if you had to choose, would you rather hold larger bars for lower premium or fractional constitutional silver for flexibility, and why? Drop your answers below. I read them, and I use them to shape what we cover next. And one more thing, if you're already doing well financially, I want you to share one lesson that helped you. A single tip, a single habit, one decision that mattered. Put it in the comments so it can lift someone else up. We need more real wins in this space, not just fear. Now, let's zoom out and talk about what the minimum order really signals about the next 30 days. Because the most dangerous phase of any shortage is the moment everyone realizes the shortage is real. At first, people think it's temporary. Then they think it's localized. Then they realize it's systemic. And the moment it becomes systemic, behavior changes. People stop selling. People stop waiting. People stop hesitating. That's why a policy like this can be a tipping point. It's a public admission that the biggest dealer doesn't want to deal with small transactions right now. Not because small transactions are unprofitable, but because small transactions drain inventory too fast. And draining inventory too fast is fatal if you can't replace it. Now here's a brutal reality. Big buyers don't just buy. They also lock up supply longer. A whale who buys 5,000 ounces doesn't flip it back next week. They warehouse it. They treat it like a strategic asset. So when you prioritize whales, you're not just changing the size of orders, you're changing the velocity of metal. Velocity slows. And when velocity slows in a physical market, availability collapses even if total supply exists somewhere. Because supply that won't move is the same as supply that doesn't exist. So the market gets tighter. Premiums rise. Back orders expand. Rationing intensifies. And the person with the smallest budget is the first one pushed out. That's why this matters beyond one dealer. This is a class-based access shift. It's a signal that the democratized phase of stacking is ending. And that is exactly how it happens in history. First, everyone can buy. Then everyone wants to buy. Then not everyone is allowed to buy. Now we're in that last phase. And if you think I'm being dramatic, look at the chain reaction. Minimum order on the buy side. Higher minimums or stricter policies on the sellback side earlier. Longer lead times. Reduced output. Refusal to pre-sell. These are not random. They're connected responses to the same pressure. And pressure doesn't disappear. It transfers. It transfers from the dealer to the customer, from the customer to the secondary market, from the secondary market to peer-to-peer. And once peer-to-peer takes off, you enter a world where pricing becomes chaotic. Because it's not one screen, it's millions of individual negotiations. That's why gray markets form. That's why local premiums explode. That's why spot becomes a reference point, not a reality. So if you're sitting there thinking, I'll just wait for the dip, I want you to consider what you're really waiting for. Are you waiting for price relief? Or are you waiting for access relief? Because even if price dips, access can still tighten. And access is the entire game in a shortage. Now, to keep this grounded, this isn't about panic for the sake of panic. This is about reading signals from the most connected parts of the retail pipeline. The pipeline just told you it's stressed. And stressed pipelines don't recover overnight. They either get relief from new supply or they get relief from destroyed demand. Those are the only two outlets. So the question becomes, what destroys demand in silver? Usually only one thing destroys demand: a price that feels so high that buyers stop. But right now, buyers aren't stopping, they're accelerating, which implies the price hasn't done its job yet. Now we reach the part that should make you feel both empowered and uneasy. If physical silver becomes difficult to source through normal channels, the person who holds physical silver becomes the one with leverage. Not a bank, not a broker, not an ETF manager, the holder. And leverage shifts fast in moments like this. That's why it feels like the rules are changing. Because the rules are changing. Now, before we close this out, remember those description links I mentioned. Bonus resources are there, including the premium WhatsApp channel and the membership option. If you want deeper updates, faster alerts, and the extra material, check those out. Also, we're offering members-only videos on a regular basis. This is not recycled content. A separate team is working behind the scenes to build deeper, more researched updates exclusively for premium members of the John AG family. If you want access, hit the join button or use the membership link in the description. And yes, I'll say it again because it matters. If you've had success, any success, share it with the community in the comments, even if it's small. Someone reading might need that push. Now, here's the cliffhanger you need to sit with. The $500 minimum didn't appear because the market is calm. It appeared because someone expects the next wave. And when the next wave hits, policies don't loosen, they tighten. So the real question isn't, is silver in a bull market? The real question is, how quickly does access disappear? Because access is already disappearing, and the biggest dealer in the room just confirmed it. So here's the move. If you got value from this, hit subscribe. Keep it simple, stay connected. And in the comments, tell me you're here by writing OG John AG. Because if yesterday felt difficult, tomorrow will feel impossible. And I want you ready before the next gate drops.